Another video, and thanks for clicking on this one. So in this video, I just want to share with you how you can use options to make some money. Now, I know that there are different strategies that you can apply when it comes to using options, but some of the simplest ones are usually the ones that will hopefully doesn't take too much time to understand and doesn't take too much time out of your own precious time to actually make that money. Because the goal is that we want to hopefully make, whether it's 10%, 20%, 30%, maybe 50% at times, and, walk away and move to the next one. So that's usually the goal. However, before you make any investment and invest in anything, it's very important that you understand the risks that are associated with the investment you are about to make. And it's very important that you are educated about it. So in this particular video, I'm just going to do a very brief introduction to what options is and understand that there's so much more to learn about options. So please, before you invest in it, I would say that you watch a ton of videos on YouTube, so many channels that talk about it, and very good information on how to really understand it. So like I said, this would be a quick intro to it. So the first thing is, let's understand what options are. All right, and it says here, an option is a contract that represents the right to buy or sell a financial product at an agreed upon price for a specific period of time. You can typically buy and sell an options contract at any time before expiration. Now, there are three main reasons or objectives why people will trade options. Okay, the first one is for income generation. If you're thinking of maybe making some money while you're trying to get into a position of a stock, or you're trying to get out of a position of a stock, you can actually think about options as one of the strategies. Now, typically speaking, if let's assume you have 100 shares of Apple, or maybe 100 shares of Palantir, or 100 shares of Microsoft, whatever the company may be, remember, the options would generally give you the ability to trade the underlying stock, which in this case, it's an Apple stock, it's a Microsoft stock, it's a Palantir stock. Now, if your goal is to generate income, you can choose to either sell a contract. In this case, you write a contract to sell X amount of shares, in this case, 100 shares of, say, Apple at a certain price by a certain deadline. So if that price does not get to the price that you've predicted, in this case, by the way, anybody that buys that contract from you pays you some money. So you make some money in that process. And if for any reason, the price that you've predicted or that you've agreed to, okay, if the stock itself does not get to that price, then that contract, depending on the strategy, expires worthless. You get to keep your stocks, and you get to keep the money. Of course, the person on the other side of the trade loses that money. On the other hand, your strategy could be hedging. In this case, if you believe that, okay, you have this amount of stocks or shares of a company, and you're worried about it going down because of maybe an earnings release or something going on in the market, you can hedge against that portfolio from going down, which means if you're worried about it going down, you probably can use different option strategies, which again, I'm not going to get into that in this video because one, I'm not an expert in this field, but I do understand the concepts. All right. So you can actually hedge against your portfolio from dropping by getting into options. Now, the last one, which is generally what you will see a lot of people do most of the time, is speculation. Speculation is the idea that, okay, you understand that this stock is maybe undervalued, and by a certain time frame, it should be trading higher. Then people can actually speculate and buy, let's say, a call if they are predicting that it's going to go up to a certain price point. All right. And hopefully their goal is that as the stock actually moves in that direction, the premium that they paid, right? So let's assume that in order for me to get the contract to buy 100 shares of Apple, I had to pay a premium of, let's for simple numbers, had to pay a premium price of, let's say, $50 to get into that, to buy that contract. Okay. As the Apple shares rises, that same contract, hopefully, depending on the time frame and all, there's some other factors that goes into it, will begin to, the value of that contract starts to go up. And that means that this contract that I signed to maybe buy Apple shares at X amount of money is now worth, instead of $50, is now worth maybe $60, maybe $70. So I can go back and sell that same contract to someone else and take the difference. So in this case, I paid $50 to buy it, but now I sold it for $70, right? And now I've made $20 profit. This is generally what you see a lot of people do when it comes to options. And this is the one that I have been able to use, which I would use occasionally. I don't do this too often because you are always open to losing a lot of money with options, especially depending on the time frame, depending on the volatility in the market. It can be very volatile. So the goal is that you want to hopefully get in by get into a stock that you have a solid understanding about, and you can somewhat predict the performance of that company, and hopefully it works in your favor. Remember, sometimes it may not go in your favor, and you have to be willing to walk away by minimizing your losses. So that's why it's very important that you don't open too much, especially depending on portfolio size. You don't take too much risk, because as you invest in options, your risk level increases, and that generally means that it's high probability that you could make a lot of money, or a high probability that you could lose a lot of money. So it all depends on your risk tolerance, and that's why I always encourage that, never invest more than 1 to 3% of your portfolio in options, because you could lose your money. Another thing to remember is that because there's an expiration date for that contract that you open, that you write, in this case, you may lose money as well. So a good example of one that I did recently, which again, this is just for educational purposes. I just want you to know that if you are interested, it's something that you can do. But this is a good one that I, depending on the situation, if I see the opportunity, it's not something I do every time. When I see the opportunity, I try to take advantage of it. So you can see on September 3, I bought, this is Boeing, by the way, that's a company. So that's the underlying stock. I bought a call. So when you buy a call, it means that you're predicting that the price of that company will go up. All right. With a strike price of $175 with an expiration date of 12/20. I bought it for one contract. One contract means that if at the time of expiration, if Boeing's stock is actually trading at 175 and above, then I may, since I'm buying it, I have the right to exercise the contract. In this case, I can actually buy 100 shares of Boeing at 175. But in this case, my intention isn't to buy 100 shares of Boeing. Okay, my intention is really to just make profit on the premium I paid for that contract. So in that case, when I bought this contract, this call contract, okay, or Boeing contract in this case, I bought it for $800, and right next day I sold it for $1,015 or $1,015 for a profit of about $215. And the same thing I did again on September 6th, bought one for $680 and sold for $900 about 3 days later. So now the main reason why this worked in my favor really is that, one, you have to make sure that you understand the type of stocks you're investing in, because if you have doubts, or if you're not sure of how that stock performs, then it can work against you. Now, there are no guarantees that this will always work, by the way, okay? But it's all speculation, right? And based on so many factors, things can change. There's so many reasons why the market can shoot up or go down. But if you have a good understanding of the stocks you are investing in, you generally increase your odds of success, especially when you understand the price action of those stocks. I wanted to share this information for those that may be new to options and may be worried about investing in options, that there are very simple ways of getting into it and not taking too much risks as well. If you have found value in this one, don't forget to drop a like on the video. I'd love to see you in the next one.